Hey everyone, welcome back to AgEcon. We are going to get started with Unit 3 today, which is focusing on macroeconomics. So as we've discussed previously, microeconomics is the economics of small firms or individuals like you and me. Macroeconomics is combining a bunch of little microeconomies into one aggregate economy. So macroeconomy looks at trade, policy, things of that nature, and we got to get started by looking at GDP. Now, some of us have probably heard of GDP, whether that be on the news or in our daily lives, or maybe in previous classes that you've taken, but GDP stands for Gross Domestic Product. So today we're going to talk about what GDP is, how it's calculated. We'll hear a bunch of different acronyms for how we measure quality of life in the United States with a variety of different metrics, and then finally we will wrap up by concluding today and looking at ways to calculate and determine how much a nation should produce in order to have the optimal amount of supply to meet demand. So we're going to get started today by looking at our learning targets as usual. So first, I can explain what is and is not included in a nation's GDP for the different calculation approaches. I can calculate a nation's GDP using the different calculation approaches. I can compare and contrast the features of nominal and real GDP. I can utilize economic data to calculate nominal and real GDP. I can describe the limitations of GDP. I can identify additional metrics used to evaluate the income and output productivity of a macroeconomy. I can connect microeconomic supply and demand concepts to aggregate or macroeconomic supply and demand concepts. And I can utilize economic data to determine the equilibrium output value. So we have a lot of learning targets today. Hopefully you guys will be able to retain a lot of this information, but as always, feel free to hit pause, rewind, come back to this video later as a refresher. Whatever you got to do to get this content. This is a very important framework, especially looking ahead into the future lessons where we're going to be talking about economic challenges, taxes. All of this content today kind of builds off of itself. So it's important to have a really solid understanding of GDP and how that's calculated. Okay, so GD what? National income accounting is the system in which the macroeconomy is monitored. It collects data on production, income, investments, and savings. Now, GDP is derived from that national income accounting system, and GDP is the dollar value of all final goods and services produced within a country's borders within a given year. GDP does not include the value of intermediate goods, and what we mean by this is, let's say that we have a bottle of ketchup. Okay, that bottle of ketchup is considered to be a final good. It's something that we get at our store shelves that we purchase. Now, to make that ketchup, we obviously need a lot of different inputs, whether that be tomatoes or sugar or even water or pastes. Those are all intermediate goods, things that are combined to create a final good, okay? So GDP does not take into account the tomatoes that were used to make that ketchup. It only takes into account that final ketchup product when we're looking at the ketchup market, okay? Intermediate goods used in the production of final goods and services. So it's important to know the difference between those two items. There are three key approaches to calculating GDP, and each one has their own pros and cons, advantages and disadvantages, and formulas. We're most commonly going to use the expenditure approach in this class, but we're going to talk about all three because they're important and relevant to know. So the expenditure approach totals annual expenditures in four different categories of final goods and services. Okay, consumer goods and services like durable goods and equipment, and non-durable goods like food. Okay, so consumer goods, that's the first. The second, investment expenses by businesses. The third is government investments through goods and services. And the fourth is net exports and imports, or X minus M. All of these things combine into the GDP equation for the expenditure approach. GDP equals C, or consumer goods, plus our investments, plus our government goods, plus our exports, minus our imports. So we have to subtract what we are importing in that GDP, because obviously we are not producing what we're importing, we are importing what we are getting from other countries. So we need to subtract that from our overall GDP. Okay, so this is the expenditure approach. We have a nice little meme over here. I did the math. We can't afford the cat. So we're going to be doing a lot of basic math equations. So kind of bear with me. We'll get some practice to apply this as well. Hopefully you like math though, because it's going to be lots of math. So the second and third approaches are called the income approach and the value-added approach. The income approach is pretty simple. It adds all of the incomes in the economy together, and that's the way we derive GDP in this approach. So this is simply wages plus rents plus interest plus profits minus statistical adjustments. And statistical adjustments are things like depreciation on equipment, perhaps any specific things that need to be revised for GDP. We'll get into that a little bit later, but the main one there is depreciation. And the third and final approach that we're going to discuss in class is the value-added approach. And this one I think is the most interesting and fascinating to learn about. This assesses the value that an economy adds to final products from production processes. So take a look at your cell phone. Okay, this is my cell phone right here. Okay, your cell phone, just a hunk of metal, right? If I were just to purchase the scrap materials to make this phone, it would be pretty minimal costs, but the fact that we add so much value to the minerals and items that go into making this phone allows for us to add a lot of value and sell this phone for a higher price, maybe even up to $1,000 depending on what phone you do have, if you have a phone. So the value-added approach considers the gross value of what we're putting out minus the intermediate consumption. So those metals, those minerals, those materials that are used to build this phone. Okay, so that is another way to calculate GDP. But again, the one that we're going to be using most commonly in class is the expenditure approach. And that's the one most economists use as well. But it's good to know all three of these. Okay, so I'd capture these down in your notes if you haven't done that already. We're going to get into some practice now. Okay, so don't get overwhelmed by what's on the left. We're not going to use all of these numbers in each of the equations. Okay, the country of Neverland is looking to calculate GDP for 2020 and wants to experiment with different approach formulas. Using the data, collect or calculate their GDP for the three approaches. So I give you the formulas for each of the three approaches. Your job is to go in here, look at the data. So I give you the consumption, I give you the exports, government expenses, all of the possible hats or buckets of accounts, if you will. I give you all of that data, and your job is to calculate the GDP using expenditure, income, and value-added approaches. Okay, so let's break it down. So expenditure approach, and if you're feeling confident on this, you can go ahead and pause and try calculating all of these on your own. Otherwise, we can do it together. The expenditure approach, again, consumption plus investments plus government expenses plus exports minus your imports. I'm basically just going to go ahead over here and say, well, our consumption is $193,700,000 and plug that in over here. And I'm going to go ahead and do that for all of the accounts. So consumption, investment, government expenses, exports, and imports. And that gives me this setup. Now I'm basically just going to add all of these components together and subtract my imports. And that's going to give me $194,700,000. That is the GDP of Neverland using the expenditure approach. Now, let's try the income approach. Wages plus rents plus interest plus profits minus statistical adjustments. Again, that's like your depreciation. We're again going to go over here. Wages, $44 million. Rents, $32 million. And we go on and on and on. That's what we should look like. We are going to subtract our statistical adjustment from the sum of our wages, rents, interest, and profits to receive $154,130,000 for our income approach. And lastly, the value-added approach is a little bit simpler of an account to calculate. Our output minus our intermediate consumption, that's going to give us $168 million. Okay, so hopefully this kind of makes sense on how to calculate using these different approaches. It's just kind of good to understand how they're calculated and what goes into that. Not necessarily the most important thing I would take away from this lecture today, but just kind of fun information to know. All right, so this is where it gets to be important to listen in, really important, because there's a big difference between nominal GDP and real GDP, and it's going to be important that you know how to calculate both of these. I'm a sucker for GDP. I think GDP is one of the most fun topics to discuss in economics. That's why I'm talking about it today. But GDP is phenomenal for real. Hopefully you kind of understand that pun I have up there now. But nominal GDP is kind of like the fake Elias GDP. GDP measured in current prices that does not reflect or account for price level increases or maybe decreases from year to year. Therefore, nominal GDP is considered to be not as accurate. However, real GDP is expressed in constant or unchanging dollars by using values derived from a base year. So this does not, it is not subject to issues with, or it is, it is taking into account the inflation and the current setup of the economy because it does use values derived from the base year. So nominal GDP does not account for price level increases. Real GDP does. Okay. So we're going to show you some practice here. So year one, let's say that an economy produces only cars and trucks. And this year they produce 10 cars at $15,000 each and 10 trucks at $20,000 each. To calculate our nominal GDP, we simply multiply quantity and price for both of these goods and then add everything together. So 15,000 times 10 is $150,000. So they're gaining $150,000 simply off of producing cars. And they are gaining 10 times 20,000 or $200,000 simply off of producing trucks. By adding these two together, we get $350,000. That is our nominal GDP for year one. Okay. Now, year two, let's say that our economy's output stays the same, but our prices increase. Okay, so 10 cars at $16,000 each. So we're increasing by, it looks like $1,000. And then 10 trucks at $21,000 each. Again, we're increasing by $1,000. So $160,000 plus $210,000 equals $370,000. Now, this new value compared to year one is misleading. Our GDP is rising because of the prices only, not because we've seen an increase in the amount of production. So nominal GDP is not preferred by economists. Economists instead prefer to have their GDP that is not affected by price changes, so they use real GDP. Okay. So real GDP then uses a base year, and our base year is going to go back to year one. So to correct for price increases, economists use real GDP and select a base year to compare year to year. So again, in the second year, we still only produce 10 trucks and 10 cars. So our real GDP in year two is going to be the exact same as our nominal GDP in year one, or our real GDP also in year one. The real GDP is $350,000, which is a more accurate reflection since production has stayed the same. So just because we are increasing our prices does not necessarily mean that we are producing more, if that makes sense. We're producing the same amount. That's why economists tend to prefer looking at real GDP. Okay. So we're going to go ahead and practice, and I would encourage you to listen to my instructions, hit pause, and try this on your own, and then we can report back. Otherwise, you can hang out with me, and we can work the problem together, and then you'll get more practice in your assignments in class. So assume that Schoolville Economy produces only whiteboards and smartboards each year. I want you to calculate the nominal GDP for year one and year two. I want you to calculate the real GDP for year two using year one as your base year, and which GDP value is more accurate and how you know. So you should have the ability to go ahead and do this on your own right now by hitting pause. Otherwise, if you're not comfortable, you want to see me work through an example with you, feel free to hang out. We'll work through it together. Okay. So the first thing that you want to do is you're going to want to identify your quantities and prices and figure out the total values for each of those. So for whiteboards, we had $750 per whiteboard and a quantity of 200. And for smartboards, we had $100,000 or $1,000 each at 120 for your quantity. And you're going to do the same thing for year two. Set it all up. Okay, so these are our values after doing that basic math. So 150,000, 120,000, 175,000, and 105,000. Okay. So to figure out your nominal GDP, again, you are simply going to add up each year's outputs, and that's going to give you $270,000 in year one and $280,000 in year two. So we've done step one. We calculated our nominal GDP. Nominal GDP is pretty simple to calculate. You simply just add everything up. Okay. Now, our real GDP is where it gets a little bit more complicated. Now, hopefully you remembered that for our real GDP, we are going to be using year one as our base year. So we are not going to care about the prices in year two. We are going to use our base year of year one as our prices over in year two when we're calculating our real GDP. Okay. So we cross out our $700 and our $1,050. and then we replace that with $750 and $1,000 to get $187,500 and $100,000 for our real GDP values, and that gives us a real GDP of $287,500. Now, in this case, our real GDP is higher than our nominal GDP, and that could very well happen in some economies. Generally, that's not the way it goes, but hopefully this opens your eyes to knowing how to calculate nominal versus real GDP. The last question on here was which GDP value is more accurate? How do you know? Despite real GDP actually being more than nominal GDP in this case, the real GDP is more accurate for year 2 simply because we account for the initial prices from year 1 in deriving our real GDP value. Okay. So again, real GDP is the way to go here. If you have questions on this or you got the answer wrong or you want to practice again, feel free to rewind, maybe make up some different numbers for yourself or have a friend or family member make up some numbers for the same problem just so you get to practice with some different values and see what you come up with. So GDP is not perfect, right? Just like you and me aren't perfect, GDP isn't perfect either. There's definitely some limitations to GDP. There are 4 key ones that we're going to talk about today that I think you should probably jot down in your notes. That is non-market activities, negative externalities, the underground economy, and quality of life. Those are the 4 key limitations of gross domestic product. Okay. First one, look how happy that guy is on his lawnmower. Non-market activities are not taken into account in our GDP. GDP does not measure goods and services people make or do themselves, such as taking care of children, cooking, and mowing the lawn. So these basic things, whether you're doing it for free for yourself or you're providing that service to somebody else, if you're not an established business, that is not taken into account into the non-market activities, and that kind of goes to the underground economy, we'll just talk about in a little bit. Negative externalities. So when we're producing as much as we do, especially in America and other countries, there's definitely a side effect, and that could generally be pollution, and that's a really big negative externality of what we're producing here in the United States for some industries. But unintended economic side effects have a monetary value that is not often reflected in GDP. So negative externalities is a second limitation. Externalities are things external, if we dissect that word, external to what we are measuring. So like side effects, so negative side effects, if that word is throwing you off, okay? Third is the underground economy. So kind of think like your black market. A lot of economic activity is not sent to the government. This could be, like I said, black market transactions or under the table wages. So if you go babysit for your neighbor or you go mow someone's lawn or do some landscaping work, these are under the table because they're not usually like reported to the government, especially if you're just doing it as like a side gig. So that is not reported in GDP, therefore that's a third limitation. And the fourth limitation is the quality of life. This is also not taken into account in GDP. While GDP is meant to be used as a quality of life metric, there are definitely factors that aren't covered by it, like your leisure time or leisure time, pleasant surroundings, safety, etc. These things don't really have a monetary value and are really hard to put into GDP. Now, if we were going to go to a kayaking rental place and rent some kayaks at an established business, that would be taken into account into our GDP, obviously, because that's a business and they're reporting their incomes and what they're receiving to the government. However, that time that we as the consumers are enjoying is not reported to the government, obviously, okay? So for this next example, I want you to assume that we are concerned only with the ketchup market in the United States in the year 2020. On the following slide, there are a variety of different options to determine which are accounted for in the 2020 US GDP and which are not. So again, we're looking at which things for producing ketchup are accounted for in the GDP. I also kind of like this meme. I threw it on here. We all know someone who loves tomato ketchup but hates tomatoes. I got several students in my classes this year. We were having a little debate, and I think in my middle school class, about tomatoes and ketchup. And you'd be surprised, there's so many people who don't like tomatoes but love ketchup. It's kind of weird, but to each their own, I suppose. So go ahead on this next slide, determine which is accounted for in 2020 GDP and which is not. I'm going to have you hit pause and report back when you're done. All right. So hopefully you have determined which are accounted for in GDP and which are not. Let's kind of walk through it together. Black market ketchup sales in 2020. Again, black market is not accounted for in GDP, so that would give us an X over here. Tomato sales to Heinz. Okay, remember, tomatoes are an intermediate good. Ketchup is our final good. So because it's an intermediate good, it would not be included in the GDP. Tomato plants degrading the soil, we can't really put a monetary value on that. That's one of those negative externalities or side effects. That's not in the US GDP. 2020 ketchup sales in Canada, because we are in the US, we are concerned with the US and what we are selling in the US in 2020. Therefore, that is not included in our 2020 GDP. The sugar used to make ketchup, again, this is an intermediate good, therefore that's not included in the GDP. 2020 Heinz ketchup sales, yes, this is included in the GDP because this is what we are producing and selling. Okay, that's the final good. Quality of life with ketchup. This isn't measured. We can't measure how happy I get when I put ketchup on my French fries. Okay, that can't really get reported to the government, so that's going to be not included. Pollution from trucks. When we're shipping our tomatoes from point A to point B, or shipping our ketchup, that is not included in our GDP. And lastly, 2019 Heinz ketchup sales, because this is the year 2020, we are not concerned with what was sold in 2019, therefore that's not in the 2020 GDP. So hopefully your graph or your chart looks something like this. If not, I would encourage you to hit pause and rewind and go back to some of the earlier slides and review. But I'm pretty confident most of you likely got all of these right. So keep up the good work. Okay, so we have GDP, but now there's even more acronyms that we should probably understand. Okay, so in addition to GDP, there are a variety of other measurement tools or metrics, I like to use the word metrics, that we can use to evaluate the economy or output levels of an economy. 5 of them include gross national product, net national product, national income, personal income, and disposable personal income. So GNP, NNP, NI, PI, and DPI. And this chart over here, measurements of the macroeconomy, does a really nice job for you visual learners explaining how all of these different metrics are linked to one another. So we see gross domestic product, yields are gross national product, and then gross national product subtract the depreciation is net national product. So you can kind of see how all of these different equations or metrics kind of flow together. Okay, so we're going to walk through each one of these individually. GNP is a measure of the market value of all goods and services produced by Americans in 1 year. Okay, so all goods and services produced by Americans in 1 year. Okay. Net national product, or NNP, is the output made by Americans in 1 year minus depreciation. Depreciation is wear and tear on important capital. So obviously, if I buy a truck in 2020 and I purchase it for, let's say, $25,000, and then 20 years later, it's probably not going to be as in pristine condition as it is the day I drive it away from the lot. Okay, so that's called wear and tear or depreciation. It's not worth as much as time goes on. Appreciation would be when we add value as time goes on, and not a lot of commodities or not a lot of goods appreciate, but definitely some can, especially antiques. When things become a lot more scarce, they can appreciate over time. But a lot of agricultural equipment depreciates because it loses value as we use it. Okay. Our next one, NNP equals GNP minus depreciation. Okay. National income is the NNP minus sales tax and excise tax on goods and services. So NI equals NNP minus sales tax minus excise tax. And excise tax is a specific tax that is put on certain commodities or goods or services that we use in the US. For example, gas. There's always going to be a gas tax. That's an excise tax. Okay. Fourth, personal income. This is simply the total pre-tax income paid to U.S. households. And then disposable personal income is your personal income minus the income taxes that you have to pay. More to come on taxes in a later lecture. Okay. So aggregate supply and demand is the next concept that we're going to be talking about. And this lends itself pretty nicely into how we're going to wrap up today when we look at production in the United States and in other countries and how a country determines how much or how little to produce to meet equilibrium. But we kind of know basics of supply and demand from Unit 1 and Unit 2, right? So again, we're coming back to this concept in Unit 3, aggregate supply and demand. Aggregate is a clump. So how many of you guys have gone outside or have planted before, like with soil, okay? You know the soil can kind of get into clumps? That's called an aggregate. So the soil particles are held tight together with the stuff called humus, which we're not going to talk about because this isn't a soil science or natural resources class, or humus, however you want to pronounce it. I've heard it both ways, but it gets stuck together. Okay, just like in the economy, when we look at overall how we're doing, we're not going to look at a supply and demand graph for ketchup, right? We're going to want to look at a supply and demand graph for all goods and services that we produce, given how much money or GDP that we have in our country. So our total income or GDP against what we are producing, okay, in a given year. This is called aggregate supply and aggregate demand. Just like we have those little particles of soil clumped together, we have all of these different microeconomies or industries clumping together to create a big aggregate. Okay, so aggregate demand is the amount of goods and services that will be purchased at all possible levels or all possible price levels in the U.S. Aggregate supply, the total amount of goods and services in the economy available at all possible price levels. So if price goes up, aggregate demand goes down. If price goes up, aggregate or real GDP goes down. If price goes down, aggregate demand goes up. And if price goes down, real GDP goes up. On the other side of things, on aggregate supply, if price goes up, aggregate supply goes up. If price goes up, real GDP goes up. If price goes down, aggregate supply goes down. And if price goes down, real GDP goes down. So kind of similar to supply and demand when we learned about as price goes up, quantity goes up for supply. And as price goes up, quantity goes up for aggregate supply. Similarly for demand, as we learned about in the individual microeconomy, the same holds true for the macroeconomy. Okay, so we are going to kind of keep this in the back of our mind, but just understand that aggregate is all of these microeconomies or industries binding together. That's going to be really important to know for now, but we're going to talk about how to set up an aggregate supply and demand graph a little bit later. Okay, so again, now the big deal question is how much then in the US do we want to produce in order to make sure that we are capping out and we're not producing too much or not enough. Okay, this is what we use. We use the expenditure approach to help us determine this. And just like there's supply and demand for a business, there's supply and demand on a macro level. And we calculate and estimate GDP and determine the equilibrium output using a total expenditure schedule. And we're going to be doing that over the next couple slides. We're going to introduce this today, and you're going to see these exact same slides in a few lectures as a way to review and kind of clump it together. So I found that it was nice to kind of introduce this concept right now, since it kind of blends itself very nicely here, and then build on it a little bit later. But if this is over your head right now, that's completely okay. We'll refresh your brain in a couple days. Okay, so we have a scenario here. It's broken down into two steps. I want to give you step one first, though. The president of Motleyville is looking to estimate its GDP equilibrium using the expenditure approach. So step one, on the chart on the next slide, I want you to calculate the missing values that belong to the total expenditure column to help Motleyville work through this dilemma. Again, your equation is going to be GDP equals C plus I plus G plus X minus M. So again, everything's added together except for your imports. You got to remember to subtract your imports. Okay, so basically here's all your data. I want you to go ahead to this total expenditure column and fill in all of these values. Okay, so go ahead, hit pause, add them up, and we'll see how you did. All right, so let's check and see how you did with your work. Again, you're going to want to add these values together, so C plus I plus G plus X minus M, and that's going to give us our total expenditure. So this gives us 5,100, 5,400, 5,700, 6,000, 6,300, 6,600, and 6,900 for our total expenditure values in dollars, obviously. So now this tells us how much expenditure we get at these various levels of output. Okay, so the president of Motleyville, again, is still wanting to figure out that equilibrium price. Okay, so determine and interpret the equilibrium on the chart. In other words, use the clues given to determine what this point of equilibrium means for Motleyville. Okay, so go ahead here and figure out which output level is our equilibrium. Okay, hit pause, do what you got to do. If you said $6,000, you would be correct. This means, as we interpret it, that our spending values equals our output. So our expenditure equals our output. So we're not going to be producing too much or too little. Our inventory status is going to be constant because we are going to be producing enough to match our expenses, and we're not going to have to do any changes necessarily as producers, okay, to keep this specific level in check, okay? So that is the end of our presentation today. I hope you found it to be informative and fun. I like GDP. I think it's a pretty great topic, and if you have any questions, feel free to shoot us an email. We'd be glad to help you out. GDP is something you're going to hear about for the rest of your life on the news. I really appreciate macroeconomics because after doing this unit in the class, you're going to have a better understanding of how the world works and how the economy works and what your role in that economy is as a consumer. So feel free to, again, reach out if you have questions, or if you didn't meet any of these learning targets, I would recommend going back and refreshing yourself. And again, you can always come back and watch this video as many times as you want. Thanks, you guys. Have a great rest of your day, and thanks for tuning in.